If you're a homeowner over the age of 55, then stop scrolling. When it comes to planning for retirement, a reverse mortgage can be a potentially powerful tool in the right circumstances. By converting home equity into a stream of income, it can provide a substantial financial boost. However, complexities may arise in certain circumstances, one of which includes when the home in question is under joint ownership. The concept of joint ownership. Joint ownership, as the term suggests, is when more than one person has an ownership interest in a property. This can be a couple, family members, friends, or business partners. Each owner has rights to the property, which can be defined in a number of ways, depending on the type of joint ownership. Joint tenancy, tenancy in common, or tenancy by entirety. Reverse mortgages in a joint ownership scenario. One might wonder, can a reverse mortgage be taken out on a home with joint ownership? The simple answer is yes, but certain rules and restrictions apply. Firstly, all homeowners must be at least 62 years old, which is the minimum age requirement for a reverse mortgage. Secondly, all owners must live in the home as their primary residence. If one owner moves out, typically because of death or moving into a healthcare facility, the impact on the reverse mortgage depends on the remaining owner's status. Potential risks and issues. There are a few potential risks associated with taking out a reverse mortgage on a jointly owned home. Non-borrowing spouse. If only one spouse is named as a borrower on the reverse mortgage, the other spouse is termed a non-borrowing spouse. If the borrowing spouse passes away or moves out, the reverse mortgage becomes due. However, recent regulatory changes have provided more protections for non-borrowing spouses, allowing them to stay in the home under certain conditions. Age disparity. Since the amount you can borrow with a reverse mortgage depends on the youngest borrower's age, there might be less benefit if there's a significant age disparity between joint owners. Early departure. If one owner moves out for reasons other than death or health, the loan could become due if they were the only borrower, forcing the other owners to either pay the loan or sell the house. Protections for joint owners. Over the years, regulatory changes have been made to offer better protection to joint owners in a reverse mortgage. Non-borrowing spouses. As mentioned earlier, non-borrowing spouses now have the right to remain in the home after the borrowing spouse passes away or moves out, as long as certain conditions are met. Multiple borrowers. If all joint owners are borrowers on the reverse mortgage, the loan does not become due until the last surviving borrower passes away, sells the house, or moves out. Conclusion. A reverse mortgage on a jointly owned home can be a complex issue, but it doesn't have to be a hurdle. If all the owners understand the terms of the loan and plan accordingly, it can be a significant financial tool. However, potential pitfalls can be severe if not navigated correctly. Give us a like, hit that follow button, and share this video with your friends and family. Stay tuned for more tips on reverse mortgages and how they can work for you.